Hello, friends. So let's tackle case number 3, signal cable. I'm going to have a seat here at my desk. Can you see me? You can barely see me. Hello. So we're looking at signal cable. First, let's talk about the participation questions. The first question is, what is the problem with question 1? The problem, let's get over here, with question 1 is not the language of question 1. It is where question 1 is situated. It should not be question 1. It should be question 7. In fact, question 7 and question 1 are the same question, if you ask me. So you have to do your analysis before you can answer question 1. So the questions are not ordered properly. Let's jump down to question 3. If you could reorder the questions, how would you rearrange them? The way I, Dr. E, would rearrange these questions would be, I would ask question 2 first, question 6 second, question 5 third, question 4 fourth, and questions 1 and 7 are the same, and I'm not sure that I would even bother to ask question 3. All right. What ratios would you do to answer question 2? And the answers are, obviously, you have the absolute liquidity, which is cash and marketable securities divided by current liabilities. And you could also do the current ratio, and you could also do the quick ratio. And let's see, what is the formula for net working capital? Current assets minus current liabilities. And perform efficiency ratios for each year. Do not average the assets or liabilities so you can get 2 years. What does your analysis tell you? Well, instead of doing question 5, let's go ahead and jump right into these questions in the book, because that will, question 5, doing that analysis is part of the problem here. So let's go ahead and jump into question 2. How liquid would you say this company is? Calculate the absolute liquidity of the firm. How does it compare with the previous year's liquidity position? So let's go ahead and do the absolute liquidity. So let's see, let's make sure, yes, we're working. So absolute liquidity, not a ratio that we go into or go over in ManFin, but it is cash plus marketable securities divided by current liabilities. All right, so let's get over to the balance sheet for signal cable, and we find that cash is, so let's do 2004 and 2003. They don't have marketable securities. They have cash of $5,000 divided by current liabilities of $895,000. Not impressive at all. And they have cash of $40,000 divided by current liabilities of $355,000. So the first thing we notice here is that cash has declined a lot and current liabilities have increased a lot. So let's go ahead and do these calculations, although I don't think they're that meaningful, to be honest with you. 5,000 divided by 895,000 is 0.56%. And let's clear the calculator out. 40,000 divided by 355,000 is 11.3%. All right, so their absolute liquidity has absolutely dried up. All right, let's go ahead and do the current ratio, and that kind of moves also into question 6. So questions 2 and 6 are similar questions as well. So we'll call this absolute liquidity. Now let's do the current ratio. And the current ratio is 1845 divided by 895, and it is 890 divided by 355. Whoops. All right, so let's do this. 1845 divided by 895 is 2.06, and 890 divided by 355 is 2.51. All right, so the current ratio has dipped as well, not as much as their absolute. And then let's do the acid test. And that's going to be 1845 minus minus inventory of 1,300 divided by 895. So let's go ahead and do that. 1845 minus 1,300 divided by 895, and we get 0.61. And then we'll do 890 minus 650 divided by 355. So we have 890 minus 650 equals, divided by 355 equals 0.68. Okay, so every one of our liquidity ratios has declined. Okay, so their liquidity is not nearly as good as it was. Let's move to let's go ahead and do question 6. Calculate the net working capital of the company for each 2 years. What can you conclude? So, working capital, current assets minus current liabilities, and we already see what's going on by the current ratio. So let's go ahead and do working capital. So current assets minus current liabilities. Get back over to the balance sheet, and so we have 1845 minus 895 1845 minus 895 is 950, and then we have 890. Oh, and it's already calculated, NWC, net working capital, but that's okay. 890 minus 355 is 535. All right, so their actual working capital has risen. So does that really tell us if there's an issue? Their liquidity has gone down, but in absolute dollars, their working capital has gone up. So if you go by this, doesn't appear to be a problem. But if you look at their ratios there, instead of dollars, it looks like a problem. All right. So let's move on to question 5. Measure the free cash flow of the firm. Question 5. All right. So let's erase this and do free cash flow. And the problem with doing free cash flow is that we can only do it for 1 year. Okay? Because we need 3 years of balance sheets to do 2 years of free cash flow. But let's see what happened in 2004. So free cash flow in 2004. Okay? So let's find our net income plus depreciation. So net income is 143,100 plus our depreciation expense, which is 79,000. Okay? So 143,100 plus 79,000 is $222,100. All right, now let's calculate the change in accounts receivable and the change in inventories and the change in accounts payable. Okay? And so the change in accounts receivable is 540 minus 200 equals 340. So that's a negative. Whew, so we've already spent. Okay, change in inventory, 1,300, 450 minus 650,000. $1,300,450 minus 650,000. And we spent $650,450 there. Okay. And let's go ahead and find the change in property, plant, and equipment. And we've got 1,300 minus 510 is 790,000 we spent on property, plant, equipment. Let's see what we took in with our payables and our accounts payables. So 895 minus 355,000. 895 minus 355 is 540,000, so that'll be a positive. All right, and then let's look at our dividends. Looks like we spent some money on dividends, and $42,930 in dividends. So our free cash flow is equal to, let's make sure we get this all correct. All right, let's clear the calculator out. And we have 222,100 minus 340,000 equals minus 650,450 equals plus 540 equals minus 790,000 equals minus $42,930, and our free cash flow is minus $1,061,280. So we spent bunches of money on accounts receivable, on inventory, and on property, plant, and equipment. Okay? We spent a lot more money on those three items than we brought in through our net income, and that could be a problem. All right, looks like a big problem if you ask me. All right, so that's question 5. Let's look at question 4. About the profit margin. You know what? Before I get to question 4, I want to look at the efficiency ratios. Okay? Let's see, since we spent so much money in these areas, let's see what they did for our sales. Okay? So let's look at total asset turnover and okay, we spent a bunch of money, are we getting sales out of it? So 2050 divided by total assets of 2913. We're not gonna, we need a trend, so we're not going to average the 2 years of total assets. So 2050 divided by 2913 is 0.7. And 1679 divided by 1247 equals 1.35. All right, so our total asset turnover has been cut in half. And we might be on the front end of a big investment the company has made. That's what it looks like to me. Okay? Maybe they bought another company, or maybe they have created a new product, but they've built up inventory and accounts receivable and manufacturing capacity. Okay? And so far, they haven't generated enough sales to make up for it. Let's look at our accounts receivable turnover, see if that's a problem. So that's going to be sales divided by accounts receivable. So we have 2050 divided by 540. 2050 divided by 540 is 3.8. And it was 1679 divided by 200. And we get 8.4. All right, so we got a big problem. They must have changed the terms of their accounts receivable, because they're not collecting their accounts receivable nearly quickly enough. So they've let accounts receivable run up, sales haven't run up as much. All right, let's look at inventory turnover. And that's cost of goods sold, 1537.5 divided by inventory, 1300. 1537.5 divided by 1500 is 1.025. And let's look at previous year, 1343 divided by 650. And it's 2.07. So they're not managing their inventory very well yet. So the problem is they've spent a bunch of money, okay, and they're not generating enough sales. They're not they're not turning their inventory over enough. They're not generating enough sales. And they're not collecting their accounts receivable. And finally, let's do fixed asset turnover. And that's going to be 1068. I'm sorry. It's going to be sales. 2050. Divided by 1068. Let's clear this calculator out. 2050 divided by 1068 is 1.92. And 1679 divided by 357. Is 4.7. So they've got a turnover issue. They've got a sales issue. Okay, that's the problem. All right, let's look at the increase in sales and the increase in the gross profit margin. So all of these ratios show us that the company has spent a bunch of money and they're not getting a return just yet. All right, so their sales are up 2050 minus 1679. 2050 minus 1679.